Silver prices have exploded through the $106 barrier in what represents complete breakdown of normal market structure rather than ordinary price appreciation. This isn't gradual bull market progression driven by improving fundamentals or increasing investment demand. This represents systematic failure of pricing mechanisms that have governed silver markets for decades. The mathematical relationships between supply, demand, and price discovery have collapsed under pressures that overwhelm traditional market capacity. The market structure breakdown becomes apparent through unprecedented divergence between COMEX futures prices and physical silver transaction prices. For decades, these markets maintained close correlation with small spreads, reflecting normal arbitrage opportunities and storage costs. This relationship has disintegrated as physical silver commands premiums that exceed normal arbitrage boundaries, while futures contracts trade at prices that don't reflect actual metal availability or delivery capability. Physical silver dealers report transaction prices $15 to $20 above COMEX settlements, while facing inventory shortages that persist despite higher prices. This violates basic economic principles, where higher prices should reduce demand and increase supply. Instead, physical demand accelerates as prices rise, indicating panic buying and supply hoarding that destroys normal market function. Traditional price discovery mechanisms cannot operate when normal supply-demand relationships break down. The COMEX delivery system faces mathematical impossibility as registered silver inventories decline toward exhaustion, while open interest represents claims exceeding available physical inventory by ratios approaching 300 to 1. Current registered inventory totals approximately 18 million ounces, while total open interest claims exceed 550 million ounces. If even 5% of contract holders demand delivery, the exchange faces impossible obligations with insufficient metal to satisfy requirements. This delivery pressure creates cascade effects where each delivery request reduces available inventory while increasing pressure on remaining short position holders. Banks and trading firms holding short positions face mounting margin calls as prices advance, while simultaneously confronting potential physical delivery obligations they cannot fulfill from available supplies. The mathematical inevitability forces position covering that accelerates price advances regardless of fundamental considerations. Industrial silver demand creates the underlying pressure that makes current market breakdown inevitable rather than temporary. Electronics manufacturing requires silver for conductivity applications where no acceptable substitutes exist at any price level. Automotive production uses silver for electronic systems and sensors that cannot function with alternative materials. Medical device manufacturing depends on silver's antimicrobial properties for surgical instruments and implants, where substitution risks patient safety. The forced nature of industrial demand means manufacturing companies must secure silver regardless of price levels because production disruption costs exceed material cost increases. This creates baseline demand that cannot be eliminated through price rationing mechanisms that work for speculative or investment demand. Industrial buyers often accelerate purchases when supply concerns develop, adding demand pressure during exactly the periods when supply becomes most constrained. Solar panel manufacturing represents particularly critical industrial demand because renewable energy deployment requires silver for photovoltaic cell production. Global solar installation targets cannot be achieved without adequate silver supplies, while alternative materials reduce efficiency and long-term reliability. This creates government policy-driven demand that operates independently from market pricing considerations because energy transition goals override cost concerns. Energy storage systems, including grid-scale batteries, require silver for power management and electrical connectivity applications. Smart grid infrastructure utilizes silver for communication networks and automated control systems. Electric vehicle charging networks demand silver for high-capacity electrical connections and safety systems. These energy infrastructure applications create permanent demand increases that cannot be postponed or eliminated when prices rise. Defense industry applications generate additional inelastic demand because military electronic systems require silver for radar, communications, missile guidance, and electronic warfare capabilities. National security considerations override cost factors when critical defense systems depend on silver components. Military procurement often accelerates when supply security concerns develop, creating additional demand during supply shortage periods. The supply-side breakdown reflects multiple converging factors that prevent normal production response to higher prices. Silver mining occurs primarily as byproduct of copper, zinc, lead, and gold operations, where silver represents secondary output. Higher silver prices don't automatically increase silver production because mining companies focus on primary metals, while silver recovery remains incidental to main operations. Dedicated silver mining operations face permitting delays, environmental regulations, and capital requirements that prevent immediate production increases. New mines require years of development and hundreds of millions in investment before generating meaningful output. Existing operations face declining ore grades that reduce silver content per ton processed while increasing costs and environmental impacts. Processing and refining capacity limitations create additional supply bottlenecks that cannot be resolved quickly when demand surges. Silver refineries operate at capacity limits while facing energy costs and regulatory restrictions that limit expansion capability. Transportation and logistics networks experience delays when valuable cargo requires enhanced security and insurance coverage during volatile market conditions. The panic buying phenomenon reflects recognition among market participants that normal supply-demand relationships have broken down permanently rather than temporarily. Sophisticated investors understand that current conditions represent structural change rather than cyclical volatility. This recognition drives accelerated accumulation that compounds supply pressures while creating self-reinforcing buying momentum. Retail investors typically increase precious metals purchases when prices break significant psychological levels like $100. However, current buying patterns show institutional participation that suggests professional recognition of supply shortage rather than retail speculation. Large transaction volumes and systematic accumulation patterns indicate coordinated purchasing by entities with superior market intelligence and substantial financial resources. International buying adds another dimension as foreign entities seek silver exposure through multiple channels, including direct purchases, futures positions, and equity investments in mining companies. Geopolitical tensions encourage diversification away from traditional financial assets toward physical commodities that provide neutral value storage. Currency instability drives additional demand from regions experiencing monetary debasement. The price discovery breakdown occurs when normal market mechanisms cannot accommodate the volume and urgency of buying interest relative to available supply. Traditional auction systems depend on balanced participation between buyers and sellers with adequate inventory to facilitate transactions. When buyers dramatically outnumber sellers while inventory approaches exhaustion, pricing becomes erratic and disconnected from traditional analytical frameworks. Algorithmic trading systems designed for normal market conditions often malfunction when volatility exceeds programmed parameters or when liquidity disappears. High-frequency trading programs may amplify price movements when momentum indicators trigger systematic buying while protective stops execute simultaneously. These technical factors can accelerate price advances beyond what fundamental supply-demand considerations alone would generate. Options market dynamics create additional acceleration through gamma hedging requirements, where options market makers must purchase futures contracts to maintain risk neutrality. Large options positions approaching expiration require increasing hedge ratios as underlying prices advance. This creates systematic buying pressure that operates independently from fundamental market considerations while amplifying underlying price movements. Margin requirements increase dramatically during volatile periods, forcing position holders to provide additional capital or close positions. When multiple participants face margin calls simultaneously, their covering purchases create feedback loops where buying pressure generates additional price advances that trigger more margin calls. These leverage unwinding cycles can overwhelm normal market capacity while accelerating price movements. The international arbitrage mechanisms that normally equilibrate prices between different geographic markets have broken down due to transportation costs, insurance requirements, and regulatory complications. Physical silver shipments between continents require weeks of transit time while facing security risks and documentation delays. Financial arbitrage becomes impossible when price differences exceed transaction costs, but physical arbitrage remains impractical. Currency market volatility adds complexity because silver prices denominated in different currencies can diverge when exchange rates fluctuate rapidly. Mining costs, transportation expenses, and storage fees all depend on stable currency relationships that become unreliable during monetary instability. These currency effects can create regional price differences that persist longer than normal arbitrage would suggest. Storage capacity constraints affect both industrial users and investors seeking physical possession. Vault operators experience unprecedented demand for precious metals storage while facing security and insurance challenges during volatile conditions. Industrial consumers require dedicated storage facilities near manufacturing operations, while investors seek secure storage independent from banking systems or government control. The liquidity evaporation in silver markets reflects conditions where normal market participants withdraw from trading activity due to excessive volatility and unpredictable price movements. Market makers reduce position sizes and widen bid-ask spreads when normal risk management models cannot function during extreme conditions. Reduced liquidity amplifies price volatility while making large transactions increasingly difficult to execute without significant market impact. Professional trading firms face impossible risk management decisions when traditional hedging strategies become ineffective or counterproductive. Statistical arbitrage systems designed for mean reversion cannot function when prices exhibit sustained directional movement. Pairs trading strategies fail when correlations break down and different assets move independently. Portfolio managers struggle to maintain risk limits when position values change dramatically within short time frames. The regulatory response possibilities include position limits, margin requirement increases, trading suspensions, or emergency cash settlement procedures. However, each intervention option carries significant consequences while potentially failing to address underlying supply-demand imbalances. Position limits cannot create additional physical supply, while margin increases may force additional covering that accelerates price advances. Emergency cash settlement procedures risk destroying market credibility if participants expecting physical delivery receive forced cash payments at artificially determined prices. Legal challenges could follow if contract terms are modified unilaterally during delivery periods. Market participants might lose confidence in paper markets, while accelerating movement toward physical transactions outside regulated exchanges. The banking sector exposure to silver derivative positions creates potential systemic risks if losses from short positions affect capital adequacy at major financial institutions. Banks providing hedging services to industrial clients face mounting losses when hedging positions move against them. Credit facilities secured by commodity inventories experience margin calls when collateral values fluctuate dramatically. Insurance companies face claims from precious metals, storage, transportation, and trading operations when market volatility creates operational disruptions and security risks. Marine insurance covering silver shipments increases premiums substantially when cargo values fluctuate unpredictably. Vault insurance companies reassess coverage limits when stored metal values change rapidly. The technology sector implications extend beyond immediate silver supply concerns to encompass broader questions about critical materials availability for technological development. Semiconductor manufacturing, renewable energy deployment, and communications infrastructure all depend on stable silver supplies at predictable costs. Technology companies may need to reconsider supply chain strategies and material specifications when critical inputs become unreliable. Automotive industry transformation toward electric vehicles faces complications when essential materials experience supply disruptions and price volatility. Production schedules and cost planning become difficult when material costs fluctuate unpredictably. Long-term contracts with suppliers may require renegotiation when underlying commodity prices exceed contracted levels. Healthcare industry dependence on silver for medical devices and antimicrobial applications creates potential supply chain vulnerabilities during extreme price volatility. Hospital procurement departments must secure essential supplies while managing budget impacts from dramatically higher material costs. Medical device manufacturers face difficult decisions about product pricing and availability when input costs become unpredictable. The monetary system implications of silver market breakdown extend beyond immediate commodity considerations to encompass broader questions about price stability and monetary policy effectiveness. When critical industrial materials experience extreme volatility, it affects general price levels and inflation measurements, while potentially requiring monetary policy responses that may prove counterproductive. Central banks face difficult policy choices when commodity price inflation results from supply shortages rather than monetary expansion. Traditional anti-inflation tools, including interest rate increases, cannot address supply constraints while potentially worsening economic conditions. Emergency intervention in commodity markets risks creating moral hazard while failing to resolve underlying supply-demand imbalances. The geopolitical ramifications affect international trade relationships and strategic materials policy when critical commodities experience supply disruptions. Countries may implement export restrictions or strategic reserve policies that compound global supply shortages while creating diplomatic tensions. Resource nationalism could emerge when domestic priorities override international trade commitments. International cooperation on strategic materials becomes more difficult when individual nations prioritize domestic supply security over global market stability. Bilateral trading agreements may replace multilateral trade frameworks when traditional commodity markets cannot provide reliable supply and pricing. These fragmentation trends could accelerate if current market breakdown persists or spreads to other critical materials. The timeline for market structure resolution remains uncertain because current conditions represent unprecedented combination of supply constraints, demand pressures, and structural vulnerabilities. Historical precedents provide limited guidance when multiple factors converge to create conditions that exceed previous experience. Market participants must navigate uncertainty while making decisions that could determine success or failure during transformational periods. The mathematical inevitability underlying current conditions suggests continued pressure until either supply increases dramatically, demand declines substantially, or regulatory intervention changes market structure fundamentally. Each resolution path involves significant consequences while offering no guarantee of stable outcomes. Understanding these dynamics provides context for recognizing that current conditions may represent permanent change rather than temporary disruption. This analysis examines observable market developments rather than providing investment advice or predicting specific outcomes. Silver market breakdown represents complex phenomena involving multiple interacting factors that can evolve unpredictably. Understanding these structural changes provides framework for evaluating current conditions while recognizing inherent uncertainty during periods when traditional market relationships no longer function normally.